Thanks for joining us. My name's Seamus Hoban, and we're here today to talk about climate disclosures for red meat processors. So AMPC's been looking at the incoming changes to the Corporations Act that will require many businesses across Australia, larger businesses, to report climate risks to their business and emissions and how they're managing those risks and in terms of financial impact to their businesses. So it's an incoming requirement that's being phased in. We thought we'd get ahead of the game, and we've commissioned a guidance document specifically for red meat processors to guide them through these changes. And so we're here today with our partners from GHD, who developed the guidance document for us. They're going to run through the changes, and also Jacob Welsh from Tees, who's kindly offered to give us his perspective, because they're sort of working through this at the moment, doing some drafting. So that's what we're doing today. I'll acknowledge the Aboriginal and Torres Strait Island people and the First Australians, and pay respects to the elders past, present, across all lands in which we operate. So that's the rundown for today. There's a QR code there, so you can link to our website where you can see the guidance document. We've produced a full version and also a summary, about a 4 or 5 page summary to, if you prefer that version. We're going to have a Q&A session at the end. So if you want to raise, we'll hold off questions, I guess, to the end, and then we'd like to have a bit of a discussion with the presenters and answer your questions. And I'll just a reminder that we're recording this session today, so just make you aware of that. And with that, I'll hand over to Leon at GHD. We've got Leon, Ruby, and Andy who will be joining us, and I think Leon's going to take the reins.
Thank you, Seamus. I'm Leon Olsen from GHD, a Senior Technical Advisor in our Sustainability Advisory. More than 25 years experience working with sustainability and climate change related matters across different sectors and countries. With me today, we have Ruby Behave, our Senior Sustainability Consultant in our Sustainability Advisory, and Andy Roy, an Executive Advisor in our Sustainability Advisory. We've all been involved with preparing this guidance document to the AMPC. We're very happy to be here with you today, and hopefully you will find this useful. Before going into the guidance or presenting a little bit on the guidance document proper, let's just consider who must prepare these disclosures. And some of you may be aware of this, but if you're not, then this might be very important information. So it's a new requirement under the Corporations Act, and there are a phased implementation across 3 cohorts of companies, or they call it groups, group 1, 2, and 3. And they are primarily determined based on the size of businesses, like the consolidated revenue of the group, consolidated gross revenue assets of the group, and the end of year employees in full-time equivalents. If you exceed 2 of the 3 thresholds in a year, you belong to that group in that year. So it's really important for red meat processors to be aware of which group they may belong to at the end of a financial year, to be able to understand what are the requirements that needs to be met in that particular year. AMPC commissioned GHD to make this introductory guide to provide red meat processors with some guidance on to assist understanding of the new mandatory requirements, to provide insights and initial guidance. It's an introductory guide. It's not it's not going to answer everything for you. Yeah, it's targeted at red meat processors that are yet to engage substantially with the new requirements. However, we do hope that it will also be useful for those that are already doing it. But in particular, Group 1 companies should probably be engaging substantially already to check progress, to consider whether they, yes, we are on top of it, or there might be something here to consider. So just as a way of checking where you're at. As I said, it's not, you can't just rely on this alone. You should also read the relevant requirements of the Act and the standard, the AASB S2 standard that must be applied, especially because the disclosures are highly contextual to individual reporting entities. You should review authoritative guidance from ASIC, the regulator, and from the Accounting Standards Board, AASB, which can be found on their websites with hyperlinks provided in the guidance. And would particularly note ASIC has issued regulatory guidance 280 that specifically addresses this. And it's not authoritative legal or professional advice. If you require that, you should obtain it. There are challenges and opportunities that we try and lay out in this guidance. So challenge 1 is that there are climate-related risks and opportunities that red meat processors are exposed to, such as climate change impacts from more heat exposure to livestock might threaten productivity and supply chain stability, for example. So that's a thing that might impact you now and in the future. This is compounded by the sector's significant greenhouse gas footprint, which might drive material climate-related transition risks in the future. But there can also be climate-related opportunities, for example, by proactively addressing some of these risks ahead of competitors. And then there's this challenge too about meeting this compliance requirement of preparing mandatory climate disclosures. So the opportunity is to try and address both at the same time. You have to spend money to address challenge 2. You have to spend effort. So try and see if you can get as much value out of that to also address challenge 1. I mean, many of you are probably already addressing challenge 1, but perhaps you can get even more value of trying to integrate it as much as possible. That's basically what the opportunity is, to try and not think of it only as a compliance exercise, but as an exercise that might also give further insight on how you can address climate-related risks and opportunities. But let's take a step back. What are the climate disclosures? And they are, a lot of people just talk about, oh, we need to do these ASIS, the Australian Sustainability Reporting Standards, but you actually only need to do one of them, not there are 2 and more to come. But it's not just that, because some of the requirements are in the Act itself and not in the AASB S2 standard. So what does the Act say? In summary, it says that a statutory sustainability report must be prepared with the same deadline as annual reporting and financial statements. It has a key element is the climate statement to be prepared using the S2 standard. And it sets out some minimum requirements. So you must report on financially material climate-related risks and opportunities. You must report on, or you must provide disclosures on climate governance, climate strategy, and climate risk management. And you must provide disclosures on metrics and targets, including Scope 1, 2, and 3 emissions. Those Scope 3 emissions are only required from year 2 of mandatory reporting for a particular reporting group. It also has, importantly, a director's declaration that is prepared, basically the directors have to declare that it has been prepared in compliance with the Act and the S2 standard. So what's important here is that you need to make sure that the directors are comfortable to provide that declaration. So that's something that needs to be thought into the process. Some of you that are into this might also know that there are minimum 2 scenarios required, and that's an Act requirement. It's not an S2 requirement. So for the required scenario analysis, the Act sets up minimum 2 scenarios of a high warming and a low warming scenario that needs to be applied. And it's also the Act that requires assurance, which has to be phased in over 4 years, with first year assurance in a group to cover climate governance, climate-related risks and opportunities, and Scope 1 and 2 emissions. Now, because of this assurance requirement, you need to have better substantiation and documentation of how you've prepared the disclosures so that the auditor can scrutinize and review it. And then there is the requirements in S2, and we'll, here's just very briefly, some further slides will tell a little bit more. The S2 standard must be applied. It focuses on financially related climate disclosures. So it's not any climate disclosure. It's what is financially material to the business. So, and then it has this objective of disclosing information about climate-related risks and opportunities that is useful to primary users in making decisions relating to providing resources to the entity. And this is important to keep this in mind. But the first thing is then, who are the primary users that's being talked about here? It's investors and creditors. And it's supposed to be not just the actual ones you have now. It's so for those companies that are not listed, you have to think about potential investors and creditors that you may not even know about yet when you think about what is the right disclosures that we need to prepare. And what are the decisions that they are supposed to, this is supposed to support? Well, it's really core financial decisions such as investing, providing loans, or proxy voting at general meetings and things like that. The S2 standard is challenging to apply. It's not a box tick exercise. Compliance can generally not be achieved by taking a rules-based checklist mindset to it. It's a principles-based standard with that objective I said before, you know, just again, require an entity to disclose information about its climate-related risks and opportunities that is useful to primary users, that's investors and creditors, in making decisions relating to providing resources to the entity. Keep that objective in mind when preparing disclosures. It's really important. Another challenge here is that a lot of the disclosures are forward-looking. It requires disclosures about climate-related risks and opportunities that could reasonably be expected to affect the entity's cash flows, access to finance, or cost of capital. That is, the red meat processor's business prospects in the short, medium, and long term. When you read this standard, and you should read it, if you want to, when preparing this, you need to read it. It's a challenging standard to read in many respects because it's not always clear exactly what's required and what's not required. You need to apply judgment to determine what is required. There's a lot of judgments that needs to be made, and that judgment is specific to each reporting entity. So you need to sit down and document these judgments as well to support the assurance requirements and possibly also support the director's declaration. It must be entity specific, both in terms of what to report and how much to report. So whilst there's lots of guidance out there, it's not a boilerplate thing. And that guidance or what others are reporting is certainly useful, can be useful to benchmark against, but it's not the answer to your reporting. You have to figure out what's relevant and material to your reporting. And again, it must focus on the on information that's decision useful. If it's not decision useful, it should not be included. There are 4 disclosure pillars. These are reflected in the Act as well, if you like. So you have climate governance, which is about what climate governance or what governance over climate-related risks and opportunities do you have in place? Like, what's the board's role in monitoring this, and what's management's responsibility? It doesn't require you to have all of this. I mean, the Act requires you to have a director's declaration, so you must have something in place for that purpose. But S2 requires you to be transparent of what you have in terms of governance. Doesn't necessarily require you to have it. So from a strict compliance perspective, it might not be too difficult to do. If you don't have much, you just need to be transparent that you don't have much. That said, if you want to do this well, and in particular addressing the strategy pillar, you also need to consider that some governance is probably a very good thing to have in place to do it well. The strategy pillar is about what are the climate-related risks and opportunities, how does it impact our business model, how does it impact our value chain, how does it impact our strategy, what are the impacts on financials. That's probably the most challenging pillar to do. That's where most judgments needs to be applied. So we'll talk a little bit more about that in a minute. Risk management is just what climate risk management do you have in place? Again, if you don't have much, you can just be transparent about not having much. Of course, having more, it might be a good thing to have to manage. If there are material risks in particular, it might be good to have risk management in place and then reporting on that. Pillar 4, metrics and targets, that's where the emissions reporting is required, scope 1, 2, and 3, but there are also some other things that are required. For example, if you have climate-related targets, you must report on them. But if you don't have any, you don't need to report on them. That can be a challenging pillar technically. There are some technical challenges for that can be challenging. So basically, you need to consider that as well. For each pillar, S2 sets out a disclosure objective that must be considered. So you have the overall objective for S2, and then you have 4 sub-objectives, one for each pillar that you need to consider. And there are specific disclosure requirements set out in each pillar. If we take the strategy pillar, which is the most challenging, I think, in addressing this, you can see here how that works in. So you have this objective of climate-related financial disclosures on strategies to enable users to understand the entity's strategy for managing climate-related risks and opportunities. In that pillar, it has 5 areas represented in that circle. About what are the climate-related risks and opportunities? How does it impact value chain? How does it impact strategy and decision making? And how does it impact the financial position and performance of the business, as well as a climate resilience assessment using climate scenario analysis. This requires significant management involvement, as senior management determinations of how the risks and opportunities affect the entity's business model and strategy is required. It also offers high potential value add in proactively informing business strategy and decision making. So I think you need to, we would encourage you to consider that as an opportunity to try and get more value out of the process. A process for identifying and assessing climate-related risks and opportunities is clearly required to be able to do this. And obviously a scenario analysis is required, which can be technically challenging and which has this requirement from the Act of minimum 2 scenarios, plus various S2 requirements that are highly contextual to the entity. To do this, we recommend an iterative approach is recommended, because it's like peeling an onion of getting more knowledge. So if you try and do all of it in one big go, you're almost certainly overscoping it. There is a minimum scope that needs to be applied, but that's again highly variable according to the entity and depends on how many material climate-related risks and opportunities you have as well. So to unpack that, it can be very good to use an iterative approach where you have one go at it, and then it's like, okay, now we know more, and we have now identified we need to know more. We need to do more to understand the scenarios for these 3 climate-related risks and opportunities, and then you make more analysis on that, for example. It can also be very useful to identify and assess climate-related risks and opportunities and assist with other disclosure requirements. So whilst it's not absolutely required to do it that way, we consider it as a good opportunity to do it at the start of the process rather than at the end of the process. Over to you, Ruby.
Great, thank you, Leon. So as Leon mentioned earlier, the standards don't actually have a set methodology or checklist to ensure that you're complying against it. And so what we've done is developed a series of flowcharts for each of the pillars. And we've done this so that it provides a bit more guidance in how to proactively address the requirements of the standard. We've created these as a point of inspiration. It's not the only way, it's just an option of how you can address the requirements. So as you can see here, we've got our flowchart for pillars 2 and 3, and those are the strategy and risk management pillars. We've combined those because we saw there's a bit of synergies in actually meeting the requirements for both of those. But I think it's important to keep in mind that these aren't separate pillars, though they're broken that way. You need to kind of have your eye and mind across all of them and how they all interact and play together. So here we have broken it down into 4 key steps. And for each of these flowcharts, actually, we've identified the purpose, the key actions, and the outcomes. And then when you look at the guidance, there's additional detail provided for each of these key actions that we've got. So in step 1 for this flowchart that we've got, it is about understanding and identifying the climate-related risks and opportunities that are relevant to your business. And that needs to be across the entire value chain, both upstream, downstream, and in operation. And a key part of that is also considering both the physical and the transition risks. The guidance document actually has some examples that are sector specific for the physical and transition risks. Then with an understanding of what risks and opportunities are out there, we need to now understand what the implications of that are. So that's where we go to step 2. So in this step, we understand how the risks and opportunities affect the business model, the strategy, the financials of the business's operation. A key part of this is understanding how it impacts the entity or the business now, but as well as in the future. So this is linking back to what Leon was mentioning earlier about the scenario analysis and how that's actually a requirement from the Act rather than specifically from the S2 standard. Then we go to step 3, which is actually integrating the climate-related risks and opportunities into the business's strategies and planning. So this is where you can actively address the risks and leverage the opportunities that you've identified into the operations of the business. It looks at how resources should be allocated to address these risks and opportunities, and then there'd need to be progress reporting on how we've addressed those. Then we go to step 4, which is actually establishing and embedding a robust risk management process. So this one looks at how the CRRO, so the climate-related risks and opportunities, are systemically identified, assessed, managed, and monitored as part of the overall risk management framework. So while this sits here, it also ties closely with the governance pillar as well. That's just an example snapshot of what we've got here. We've got additional details in the guidance, but that's it from me. Leon, I might hand back over to you if you've got anything more to add on that.
No, thank you, Ruby. Yeah, I mean, what we're trying to do here in this presentation, just to give it a little bit of a snippet for you to go into the guidance. A lot of these things are explained, we hope, we think, clearly in the guidance to get you to understand. So hopefully this just gives you a little more impetus to try and go into the guidance and see these things. As Ruby was saying, some of that detail on the previous slide is inspirational. It's not required that you must do all of those things at all. Some of you will have some things in place that are doing those things already, and then you should almost certainly leverage that, and perhaps you need to think about how you can expand on it if that's relevant. But you know, it's not about this is about making sure you are both pragmatic as well as the guidance would certainly say, as well as trying to be a little bit ambitious. You have to do these things anyway, so you can try and get more value out of it. But you know, it's another thing that's important to remember is you shouldn't let the perfect be the enemy of the good. So try and be pragmatic about this. So really thank you for listening, and I think the questions are coming at the end, but otherwise this deck has been provided to AMPC to sharing with you, and so you will see our contact details there if anyone have further questions after this webinar.
Thanks, Leon. Hopefully you haven't scared everyone off with that, but I think one of the challenges in doing this guidance document is we notice that different processes are at different stages in development and are engaging with this more or less, but we wanted to provide a guidance document that is comprehensive, but people can choose the parts that are most relevant to them, I suppose, or go into more or less detail. And one of the challenges really is that we're trying to put a structure around something that has a lot of grey areas in terms of the Act and the standard. So we can't we can't just sort of tell you what the answer is. It's something you have to go through yourself. So that's the guidance document. We thought now it would be good to get a processor's first-hand experience, and so Jacob's kindly put his hand up to talk about how T's are approaching this. I think you're in the stage now, Jacob, of sort of drafting your disclosures. So over to you to hear some of your experience, and then we'll just jump into some questions after that.
Thanks, Seamus. I haven't prepared any presentation for today, but yes, AMPC have asked me to provide a processes perspective. So I've got a few talking points here that I'll run through. And just to preface I guess the conversation is that every individual and organisation will have a different perspective on how to approach the disclosures, like the amount of information, the value of it. We talked a little bit about compliance versus value. So this is one perspective around how to approach the disclosure, or how we're thinking about it. So I guess just to start, it's obviously a first for the industry and Australian businesses. So we're starting on a pretty low maturity curve with regards to what's required for these disclosures, scenario analysis, that sort of stuff's quite new. So I guess it's just the acknowledgement that this is a learning process and you're not going to get it perfect first up. So we're taking sort of meaningful steps just to begin that journey. And to go back to sort of what Leon's saying around the standard, the key thing we're focused on is, what does the standard actually ask for? And there was a lot of like comments about that being grey or talked about judgmental, but I think that's a good reference point, is read what the standard actually is asking for those particular dot points and provide factual information in relation to those particular points. Avoiding added unnecessary information to the report. So as an avoidance. So we're thinking about being very streamlined in how we're approaching the disclosures, make it clear, defensible, and compliant. So no more or less than that. Keep it very disciplined around what does the standard ask for and delivering that. When it comes to the assurance side of things, like most people on the call probably are aware, but there's an escalating assurance timeline in relation to AASB S2. And in the first few years, the assurance is limited to governance, a couple of sections of strategy, and scope 1 and 2 emissions. So if you're talking about prioritizing your area of focus, that's really where we've been focusing those areas of that actually require assurance. Scope 1 and 2. So we talked a little bit about scope 1 and 2. Some of the people on the call are probably familiar with scope 1 and 2 reporting through ANGERS. One of the key differences of these disclosures is we've got livestock emissions for those that own feedlots are included in these disclosures. So that's a bit of a new process in which we're having to put measurement in place and processes in place for that. But one of the key takeaways, I guess, around the scope 1 and 2 is getting an audible assurance ready inventory. So, because that's where a lot of the assurance activity will come, on making sure that there's solid, robust processes around that GHG calculation. Scope 3 is obviously not part of the first year's reporting. If you haven't focused on that, I'd recommend start thinking about that. Our approach to that, you could take many different approaches, and coming back to your business's position around perspective, you could spend as much time and money on that as you want, or look for more streamlined approaches. Our internal approach to that is we're looking for the most cost-effective approach to getting a compliant Scope 3 inventory, one that complies with the disclosure requirements but doesn't incur significant consultancy costs. So that's been a pretty big focus. So one of the key sort of catch points, or I guess areas of focus that we're considering moving forward on this is, it's probably just a focus for all processes. Just be cautious of consultancy and assurance scope creep. So like Leon's mentioned, there's a lot of judgment potentially being applied. We're at a low maturity. That includes not just processes, but auditors. So there'll be a tendency to or a risk of them applying certain judgment to certain things around your disclosure. So you'll have a different perspective on how your business will approach this, but we're being very deliberate around going back to what the standard asks for, making sure we're keeping consultants and assurance within scope of the actual requirements. We see this body of work as it escalates in time through the assurance process and getting scope 3 and higher levels of assurance. It's quite an attractive work stream for the consultancy industry. It's an attractive work stream for assurance providers in there's an annual body of work there, right? So there may be pressure to broaden the scope, add complexity, increase the analysis, essentially increase cost, right? So it's about processes being disciplined around, is it required? Is it material? Does it actually improve the disclosure? And is it actually worth the cost? So that's a big consideration in how we're thinking about where the disclosures could go and being very factual around what we're reporting. One of the conversation pieces or thinking about is like report length. What does the disclosure actually look like? How big is it? So I've seen some of the published reports come out and they range from 7 pages through to 70 pages. So there's similar to the perspective of different businesses applying a different level of diligence or attention to that reporting aspect. And that's going to be up to each business around that effort versus value, what your stakeholders are actually the expectations. Whether you're public listed or you've got private owners and what their expectations are. And I think most reports, from what I'm seeing, we talked about climate risks and opportunities. I think they're flagging between 1 and 2 risks and maybe 1 opportunity. So this isn't a report of 50 risks that you're reporting. You're disclosing what risks are material to your business as far as the financial impact. And just thinking about our context at Tees, we're really aiming for a report between 10 and 15 pages. Like, we're trying to keep it concise and short. So just sort of summing that up, it's the learning process. We're all learning. We're starting from a low base, focusing on what the standard actually asks for and being very, very deliberate around that. Prioritize what is in assurance for the first few years. Like that's what you should be focused on, what needs assurance. Get your scope 1 and 2 assurance ready. And audit ready. Keep it practical, proportionate, and cost effective. That's our key takeaway. Our belief is this should be an internal capability, and we shouldn't have to go and spend hundreds of thousands of dollars on consultants for us to report this stuff. And yeah, just it's up to your business, but resist unnecessary complexity and scope creep. Keep it tight, keep it simple, keep it factual. And yeah, there's some of the key perspectives I guess I can offer, Seamus. So that's all I had.
Perfect. Thanks, Jake. That was good perspective. We'll open it up for questions. I don't know. There might be someone on the line who are into the process as well, or you've got questions for either Jake or Leon. Just pop your hand up, and we'll unmute you if you like. I might start off with one for Leon. Just interested, like that we've got a lot of different types of businesses in our industry, from sort of foreign owned or partly foreign owned through family companies or co-ops or what have you. How does that change the way you should look at this, or does that make a difference?
It does make a difference, but notionally, ownership isn't relevant as to whether it's required. Yeah, so it's not a matter of our listed companies have the same requirement as a smaller, eventually as a smaller Group 3 entity with material climate-related risks and opportunities. But in reality, it matters because, yeah, it's a principles-based disclosure regime focusing on these objectives. Yeah, so if you're a bigger business, you might have more investors and creditors that needs to be informed. Certainly, if you have more climate-related risks and opportunities that are material, there will be more to report on. So it's highly contextual. It's not necessarily based on what is the ownership. It's more based on what are the material climate-related risks and opportunities. And that's where I think Jacob's comments on keeping this focused on what makes sense for your business is extremely important. We're obviously consultants, so we obviously can also sometimes be accused of may overscope some things. The point here is that it's important to keep it valuable. I agree with Jacob on that, and I certainly agree with the fact that the management should take their view on this. As we're seeing in the guidance, a lot of management judgments are required. There's a lot of gray areas. You need to work out what to report, and that therefore also comes back to it doesn't matter what size you are, you have to report something if you're required to report. But exactly what that means, Jacob says some people are reporting 70 pages. I think they're, without knowing what they are reporting, that sounds to me like they are overscoping it. You probably should report less than more, but being confident that you have reported in compliance with the Act and S2, to report short might require more preparation, because you need to have more documentation for the board to make that director's declaration. And you need to have more documentation to the auditors for them to agree. So short reporting might require more preparation than long reporting.
I might just make a comment on the report length. So yeah, to your point, Leon, I think a lot of those longer reports are more from publicly listed companies that might add a bit of extra information or context to their reporting. I guess the key touch point or focus for businesses where they might not be focused on that is assurance providers or auditors looking at those reports as a bit of a baseline or gold standard and try to push that level of reporting through. So that's when I talk about just being conscious of the scope, what it's asking for. That's probably where that feedback's coming from. So it'd be interesting to see how that evolves, because some of these longer reports might be held up by the consultancy crew that are doing the assurance and say, this is the gold standard, this is what we expect moving forward. So just a point to be aware of. Yep.
All right. Just pop your hand up if you've got a question. But the other thing we've been talking about is in terms of emissions, expenditure-based calculations or activity-based calculations. Do you want to explain the difference there and what people should be using? Either Leon or Jacob might have different views.
Leon can talk about it.
We definitely seem to have different views, and I'm not sure exactly what is the right view. It's a particular challenge, the Scope 3 emissions, and S2 refers to what's called the Greenhouse Gas Protocol, which is an international standard for how to do emissions reporting. So just before we go to the Scope 3, it does that for Scope 1 and 2 as well. But if you're an ENGA reporter, you can then use ENGA for the emissions that you're reporting under ENGA. But then you have to, if you're not using ENGA, you have to use Greenhouse Gas Protocol. So for smaller red meat processes that might not be under ENGA, you have to use Greenhouse Gas Protocol. The same thing then applies for Scope 3. It refers to the Greenhouse Gas Protocol. But then it actually sets out its own measurement requirements for Scope 3 specifically. You're not allowed to use the measurement requirements under the Greenhouse Gas Protocol. The measurement requirements for Scope 3 under S2 are particularly challenging to read. I've been reading them. I'm a registered greenhouse and energy auditor. I know how to understand how to read these types of things, and I struggle. I've read them many times, and they are particularly hard to read. I mean, it starts out by saying that you should prioritize direct measurement of Scope 3 emissions. What they mean by that is direct emissions monitoring at source. That doesn't even happen for scope 1 emissions. For most scope 1 emissions, that's not being done. So why should you do that for scope 3 emissions? It's completely impractical. And yeah, I don't know where that comes from. It just seems to be wrong to even suggest that that should be prioritized for scope 3 emissions. It then sets out a lower standard that's allowed, which it calls data from specific activities in the entity's value chain. To me, that clearly suggests activity-based emissions estimate for scope 3. What is an activity-based estimate? It is, for example, you buy X amount of widgets, and then you say, quantity of widgets, we find an emissions factor that can be used to estimate the emissions from this type of widget we buy. And then we multiply the amount with the emission factors to get to the estimated emissions. So you basically need to go and find data for all of these activities. That for travel, like for transport, it could be kilometers of transport, and then times an emissions factor for transport per kilometer. Yeah, so you need to then go through and find all of these things. So that can be quite time consuming. Jacob is right, it can be quite expensive process to do. Spend based is an approximate one where you basically use the dollar spend on, for example, transport, and then you find an emission factor per dollar spent. It's the most unreliable scope 3 emissions estimate that exists, but it's the cheapest and most quick, and it gives you a good scope order of magnitude idea of how many scope 3 emissions might there be. So it's a very useful process, especially initially, to try and find out what the order of magnitude is, and therefore potentially start to prioritize where to try and do more. The question is whether it's allowed, and I think scope S2 doesn't give a straight answer. I don't think it's allowed, but I'm not the one to answer this question. You know, I haven't seen the answer yet from ASIC or from AASB. So I think the answer is the auditors. So you need to go and ask the auditors what they think is required. There's no doubt if spend-based is allowed, it's much cheaper. I suppose one other thing to consider, if you want to manage emissions, if you want to manage scope 3 emissions, spend-based emissions estimates are pretty poor, because you know, just take spend on fuel. You know, fuel has just doubled in cost, but it doesn't mean that the emissions have doubled. Yeah, but they would come out as double under a spend-based emissions approach. So they are useless in managing emissions and setting emissions targets and managing against the target. But they are very useful as an initial idea of order of magnitude for scope 3 emissions. Are they allowed? I think not, but I'm not the judge of that. So that's my perspective.
Yeah, I might chip in. The diesel one, like for example, a diesel it'd be interesting to see, Leon, how that fleshes out. Our view on this is that you know, activity based versus spend based both are inaccurate, right? Like we're never going to get an actual accurate scope 3 data set. So it's just about which one's less inaccurate. And we're looking at just the way we're approaching it is just value, like value for money. Is it valuable for an organization like Tees to spend hundreds of thousands of dollars on understanding our scope 3 footprint? Probably, if we were heavily focused on reducing emissions in that space, we're probably more focused on actually finding abatement solutions than getting that number 100% accurate. So our approach is spend based for scope 3. And to Leon's point, he doesn't think that spend base is allowed. The standard talks to estimations by emissions factors. Our advice is that spend base is allowed. So it might be a point of clarification for processors to get off the call and engage with their auditors and or experts. But I think the approach to this that we're taking on emissions is it needs to be cost effective. Like it needs to be value for money. It can't be going around measuring emissions for our 8,000 producers or not. And in saying that too, the government has released some draft emissions factors for a spend-based approach for livestock and things like that. So the government's signalling that spend-based is a legitimate way to calculate those emissions. But I guess we'll work through that, Leon. What's allowed and what's not.
Yeah, as I say, I'm not the final authority on this anyway. So ask your auditors, I think, is important, because they will have to take a view.
Yeah,
maybe we could just tell the auditors this is what we're doing. Yeah, that's another approach.
Yeah, perhaps.
Good luck. All right, if there's no other questions, I suppose the only other thing in my mind is processes are hugely impacted by climate in terms of short-term climate and drought, and how do you separate that like that's a huge impact on your financial year-to-year cycles and climate cycles, but how do you separate that from long-term climate impacts? I imagine that would be quite difficult, Jacob, to separate that out.
What's my view on this? If we knew what was going to happen in 2050, we're making the idea of the disclosure is to make a judgment based on potential impact. And I think as an industry, we deal with climate now already. Like we've been dealing with climate variability for since our existence, right? So it's about, to me, it's about using that government information that's out there, where they predict what the temperatures or certain areas might be impacted into the future, and doing our best to try and make an assessment of potential impacts to our business. And again, that's not easy. And my view around that is, I don't know how you could be right or wrong in that assessment. Like, all you can do is formulate a view, have that view reviewed, come to an agreement around, yeah, that's what we think the impact could be. But I don't think there's a clear answer to that question, Seamus. Like, we deal with climate variability now, so that's the norm. It's about what does that look like in the longer term, like wider variability, and
increasing from your base case, I suppose.
And like, I think, like, working through this process, if we think about the risks, the transitional risks are probably more of the key impacts on our business at the moment in policy and energy pricing, and the diesel situation. Like, these are the sort of policy prescriptions or transitional risks that are actually having tangible impacts on us, not so much the climate impacts yet. That's like potentially longer term. It's more the policy settings that are material things at the moment.
Yep.
If my view on this is that this is where the scenario analysis has particular value. Clearly, red meat processors, and in many other industries are, but red meat processors certainly more so than many industries, are already impacted by climate change, as Jacob is saying, and then you're saying, Seamus. And transition risks are coming as well. Will the updated safeguard mechanism, when it gets updated, will that suddenly make more? I think most red meat processors are not safeguard facilities, just below the quite high threshold for it, but that might change. Then suddenly you have an additional transition risk. So there's things here. Scenario analysis is particularly useful to try and work out what this might mean in the future, and therefore separating out what is just what normal business and what is what might happen in the future. And it's a particular strategic exercise trying to visualize a probable, or not probable, a plausible scenario based on evidence from, like, in terms of physical risk, physical climate risk projections that are relevant to the entity, like the location of the entity or the location of the key supply chain aspects to try and understand, well, are we going to be, how much more rain or drought or heat is going to occur? And then from that, trying to visualize how much may that impact our business in the future. Now, it's not an exact science, so that's also where a lot of judgment needs to be had. And like, we're talking about consultants, yeah, like we help businesses in that, but we're saying we can help you with the technical aspects of this, but we can't help you with the business judgments. We have to facilitate that you do business judgments, because these are business judgments on how does this impact your business prospects. Like we have done it for, we did it for a coal mining company where we thought this would be significant risk, but then it turns out no, because they already have a lot of things in place to manage that risk. So it turned out it wouldn't be so material to their business. So and there's no way that as an external consultant we would know this. You know, this can only come through with senior management being involved in then triangulating this different information and coming to a view on what does this mean in this future scenario. And what our experience is that management has often found that particularly useful, you know, these types of, we have a workshop to try and visualize how might this impact our strategy and business model in the future, and what are the climate related risks and opportunities under these types of scenarios. The same thing with the transition scenario. You set up a transition scenario and you start working out, well, what might be the transition things that happen in 5 years time or in 15 years time that might have an impact on our business.
Yep.
They're not final answers. They are because a lot of uncertainty. So it's about trying to come up with a plausible scenario to try and stimulate thinking about how it might impact the business.
All right, very good. If there's no more questions, we might call it to a close. But yeah, thanks to Leon and Ruby and Jacob for being available and to talk through this, and hopefully we haven't scared people off too much. And I suppose we're always open to hear from processes about what more we can do, any other guidance or tools that you would be interested in. Let us know. Have a chat to Matt Deegan, and yeah, it'll be a bit of a journey, I think, for all of us, but we will see how we go. So I'll thanks everyone for your participation, and I'll sign off, I think.
Thank you.
Thank you so much.
Thanks all.